I want to show you a new indicator that's honestly way more powerful than it looks at first glance. It spots strength shifts between buyers and sellers with surprising accuracy. And today, I'm going to walk you through two full trading strategies that you can build with it. Both are extremely beginner-friendly and very profitable when you follow the rules properly. Just stay with me through the video and you'll understand exactly how to use this tool in real trades. Now let's get started. I'm on TradingView. First of all, open Indicators and search for Directional Imbalance Index. It's the new one from Big Beluga. Add it to your chart and you'll see it appear below the price. At first it looks a bit unusual, but once you understand how it works, it becomes one of the cleanest strength reading tools you'll ever use. The whole idea behind this indicator is simple. It counts how often price is printing new highs or new lows inside a look-back period. Every new high increases the bullish count, and every new low increases the bearish count. These little marks up here represent bullish counts, and these represent bearish counts. All of that data is then combined and reflected in this cumulative oscillator below the chart. The indicator is basically telling you, in real time, which side is gaining strength and which side is losing it. On the right side of the panel, you also get a dominance percentage so you instantly know who has control. For example, if you see some more percentage on the blue side, the market is bearish dominance. That means sellers currently have the upper hand and the market structure is leaning bearish. Inside the oscillator, the orange line represents bullish pressure and the blue line represents bearish pressure. When one rises, the other falls. It's showing the tug of war between buyers and sellers. If the blue line starts climbing while the orange is dropping, sellers are taking control, and the market is shifting into a downtrend. If the orange climbs and the blue falls, buyers are winning the battle, and the market is shifting into an uptrend. Because of that, the crossovers between these two lines can often be the beginning of a completely new trend. When the orange line crosses above the blue line, bullish pressure is taking over. When the blue crosses above the orange, bearish pressure is taking over. The indicator highlights this automatically by coloring the area between the lines orange during bullish dominance and blue during bearish dominance. It helps you instantly recognize which side is in control. But we don't enter trades only based on these crossovers. If you do that, you'll get plenty of false signals because trends don't always shift cleanly. So the first strategy we build uses the crossovers only as confirmation, not as the entry trigger. This strategy focuses on reversals, so we combine this indicator with RSI divergence to filter proper turning points.
Do you feel like everyone around you benefits from artificial intelligence, but you have no idea where to start? Don't wait any longer. Start today. Our free trading bot is simple to use, powered by artificial intelligence, and can earn you up to 1% profit every single day. Over 500 members have already joined. Click the link below now to get free access. This is your chance to harness the power of AI and take a step toward a financial boost.
So open the Indicators tab from here and add the RSI indicator to the trading chart. Now let's continue. Add it with default settings. For a reversal setup, we first want divergence. For example, imagine price pushes up, creates higher high, but RSI refuses to make a higher high and instead creates a lower high. That means downside momentum is quietly increasing. This is called bearish divergence, and it gives us the first clue that the trend might be ready to shift. But divergence alone is not enough because divergence appears during pullbacks too. So right after divergence forms, we look at the Directional Imbalance Index. The moment the blue line crosses above the orange line, sellers finally take control. This is our confirmation. When that crossover closes, the reversal setup is complete. And in practice, we would open a sell position there with a stop loss above the high of the divergence pattern. And as you can see in the example, that reversal led into a clean downtrend. Same logic applies for bullish reversals. Price makes a lower low, while RSI makes a higher low. That means upside momentum is building quietly, even though price is still falling. After that, we look at our indicator. When the orange line crosses above the blue line and closes, buyers take dominance. That confirms the reversal, and we enter a buy position with a stop loss under the low of the divergence. The price shifts into an uptrend and the trade becomes very profitable. You'll notice these patterns repeat throughout the chart. Divergence first, imbalance crossover second. Every signal will not win, and that's normal. No strategy in the world has 100% accuracy, so risk management is the key. Now let's move on to the second strategy, which is a trend-following approach. This one is extremely simple. First, we add another indicator to help with pullbacks. Search for stochastic and select the built-in one. After that, open its settings and set K% length to 7. Then set K% smoothing to 3. Keep everything else the same. Now the directional imbalance index tells us the trend direction. When the blue line is above the orange line and the area is colored blue, the market is in a downtrend. In that environment, we only look for sell opportunities. The stochastic helps us time entries by showing when a pullback is ending. In a downtrend on the imbalance indicator, like we have got over here, we wait for the stochastic K% line to go above 80. That means the market is overbought inside a downtrend, which usually produces a pullback. Then we wait for the blue line to cross back below the orange line, just like we can see happened over here. When the cross closes and we are still in a downtrend according to the imbalance index, the sell signal is confirmed. We enter the trade with a stop loss above the previous swing and target around 1.5 times the risk. You'll see multiple entries like this in a row. For buy trade setups, we do the opposite. When the orange line is above the blue line and the area is orange, the market is trending up. We look only for buys. We wait for the blue line to fall below 20, showing oversold conditions inside an uptrend. Then we wait for the blue line to cross above the orange line. We only enter once the blue line is back above 20 again. That tells us the pullback is ending. So we enter the buy trade with a stop under the previous pullback and aim for a 1.5 risk to reward. As always, trend trading works beautifully when the market is trending, but it becomes very unreliable when the market is flat. If the imbalance index shows constant flipping without clear dominance, that means the market is ranging, and you should avoid trading these signals. It's always better to wait for a clean trend to form before using a trend strategy. Again, there is no trading method that removes false signals completely. Losing trades will always be part of the journey, but with strong risk management and a structured approach, you can trade with confidence and consistency. That's it for this video. If you have any questions, feel free to drop them in the comments. I answer as many as I can. And if you haven't subscribed yet, make sure to do that so you don't miss the next breakdown. Thanks for watching the video till the end, and I'll see you guys in the next video.